Guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is Sunday. It is January the 2nd. So it's too late to say Happy New Year because if you missed the previous video, I had already said that. So now it's January the 2nd. And in case you missed that video, I wish you the very best of success, good health, and happiness for 2022. I hope it's going to be an excellent year. So I'll tell you what this video is all about. I want to talk a little bit about S&P 500 ETFs, so index funds that kind of mimic the S&P 500. And specifically what I'm going to do is talk about BlackRock's funds. There are three companies that pretty much own everything in the world today, and they are State Street, Vanguard, and BlackRock. And when I say they literally own everything in the world today, you can almost look up any mega stock that exists, and you will find in the top 3 or 5 holdings of institutional investors, you will find BlackRock, Vanguard, and State Street. It just repeats again and again and again. These companies pretty much own everything. I had to pick one. I picked BlackRock. The sort of background to this particular video is some discussion, brief discussion with Bulldogs #1 on the channel, and then I also read a really great LinkedIn summary of 2021 by Isaac Edelman on LinkedIn. And, it just got me thinking, some of us take enormous risks with some of the single stock positions that we have. And how do index funds really compare? Because we know that the S&P 500, for instance, for 2021, generated a return of almost 30%. In fact, if you were in an S&P index type fund and you reinvested your dividends, you could very comfortably have achieved a 30% return on investment for 2021. The other thing that's interesting about that is only 3 hedge funds, according to Bloomberg, actually beat the S&P 500. Many of them did very badly overall. So what I did was I put together an overview, as I said, about BlackRock specifically, and that's what I'm going to talk about. And I'm going to specifically target the S&P 500 ETFs by BlackRock. Not all of them. I've just picked a few. So what we're going to do first is, just for fun, I just want to make sure you guys are familiar and understand the concept of compounding, because this is really how you build wealth. It's through compounding. It's not through entering and exiting positions, buying and selling stocks, day trading, and all that kind of stuff. Many of those things are super high risk. Of course, there are a lot of people who make a lot of money doing those types of trades. The majority of people do not. So what do we want to do? Learn about compounding, because this is certainly a way that you can build generational wealth over time. So the questions here are, they seem to be quite simple, but think about them a little, right? And I'll give you the answers at the end of the video. Which is better, a gift of $10,000 today or a penny that doubles every day for the next 30 days? Which one would you like? Shall I write you a check of $10,000, or would you like a penny every day that doubles for the next 30 days as a gift? Wild water lilies are growing on a pond. This is the second question. And these wild water lilies that are growing on a pond are doubling every day. After 50 days, the water surface will be covered 100% with lilies. On which day was the pond 50% covered with lilies? They sound like simple questions, but they are compounding questions. They're made to make you think. And I'll give the answers before I wrap up this video. Let's take a look at BlackRock. So I've picked 4 of them, right? So the ticker symbols are over here: IVV, IVW, IVE, and IJH. One of them is significantly different to the others because the one on the far right is their iShares S&P Mid-Cap ETF. The others are basically mimicking the S&P 500. This one is the core S&P 500 fund. So in other words, it covers pretty much everything. This one is growth-oriented, and this one is value-oriented. We'll take a look at what that means in just a second. The expense ratio on these are quite low. So now remember, if you buy a stock, effectively, you might pay some brokerage commission. And nowadays, you might not pay any brokerage commission at all. And after that, you own the stock free and clear. Whereas if you invest in an index type fund, like an ETF or a mutual fund or something like that, you're going to pay fees. Before you do that, it would be worth your while to know how much they are going to charge you for the services that they offer. Right at the bottom, you can see the gross expense ratio, the net expense ratio, pretty much the same thing. 0.03%, in other words, almost nothing. But the second one, the growth one, 0.18. Now, there doesn't perhaps seem to be a big difference based on a an ongoing fee of 0.03 and 0.18. But I promise you, if you do the math, 0.2 from a compounding point of view will eat into your investment super fast. So just based on the fees alone, you'll see the mid-cap one on the far right is 0.05. Based on fees alone, I would automatically eliminate both the growth and the value ETF. Of course, we also want to see how they performed, but anytime I have to give away some of my hard-earned cash, I am automatically somewhat resistant. So I would default to the one on the far left, which mimics the entire S&P 500, or the one on the far right, which mimics the mid-cap holdings within the S&P 500. How about the annualized return? So here we have year to date and the net asset value. So this is as of December. In other words, it's very, very current. We're looking for the year for 2021 that has just passed. The S&P 500 fund that mimics the entire S&P 500 generated almost 30%. And then the growth and the value funds, respectively, 32 and 24, and the mid-cap also 24. So now already I'm leaning towards, if I were to make an investment at all, IVV, better performance, lower cost. Then if we look at the PE ratio of these three funds, you can see that right now the price equity ratio for these four funds is relatively high. So the average S&P 500 historically has been around 15 or so. Now, right now it's actually higher. So that's why many people say we're in a bit of a bubble, right? So the S&P as a whole, the index, has a PE ratio that is arguably higher than where it perhaps should be. The lowest PE ratio are the two on the right here, but I've already pretty much eliminated them. So now I'm looking at a PE ratio of about 34 if I want to get into IVV. I'm not going to care too much or spend any time talking about sustainability characteristics because that's not my thing. How about this? If I look at the actual holdings of the particular funds, the core S&P 500 ETF has 505 holdings. That pretty much just means by definition, it holds all the stocks in the S&P 500. The growth fund is targeted at approximately 240, the value fund about 450, and arguably most of the stocks in the S&P 500 are somewhat, to a degree anyway, value investments anyway, but you'll notice the difference there. The growth ETF only has 240, so about half. And then the mid-cap, about 400. And it's also fair to say that approximately 80% of the S&P 500 are mid-cap companies. What are the major holdings? So you can see tech-heavy, Apple, Microsoft, Amazon. So now I have a little bit of a concern here because I don't really want to go into technology and look just down this list here. This is heavily, heavily technology weighted. So I might look at some of my other ETFs that I use from time to time to park stocks. One of them is technology weighted, that's SPY. The other one is VYM, which is more sort of a general market value ETF. VYM is probably preferred in terms of this particular example here, but I might be tempted to plug a little bit of cash into IVV. And the reason for that is I have cash awaiting investment. I need to park it somewhere. So do I add to my VYM or SPY, or do I perhaps look at adding some cash or opening a new position in something like IVV? The growth one is pretty much the same, right? So these are the growth companies, Apple, Microsoft, Amazon, etc., because they have been historically over the past year or two. That's where we've seen most of the major growth. Now, for those of you who've been following me, will know that in 2021, my portfolio was heavily biased towards financials and energy. Man, that worked out well for me. So maybe I got lucky because I'm not really smart. But those holdings that I have in the financial sector and energy sector have paid off handsomely for me. And the guys who are in technology, especially heavily weighted in technology, like our friends from ARK Investment or whatever, have taken a bit of a pounding. You can argue mainly because of Tesla, but many of the tech stocks pulled back. What about value? So a little bit more diversified there. We've got Berkshire Hathaway, Johnson & Johnson, Procter & Gamble as the top three. And then it drops off, but you can see there's a couple of energy stocks here, ExxonMobil and Chevron. And then the mid caps, not companies that I typically look at and not companies that I'm very familiar with, Molina, I know some of these companies, but superficially, so I'm not going to comment on them. Molina, Camden, and Builders First Source. So that's kind of where they invest. Right now, in terms of what I shared with you, I would lean towards the core 500 ETF if I was going to park any money at all. So that's IVV. As of December 30th, for all four of them, they were heavily weighted. Information technology, the first two, but the growth one, almost half, 44% of the holdings in terms of sectors was in information technology. So the IVV fund, which is kind of where I'm leaning, maybe I'm a bit conservative in that regard, information technology 30%, healthcare 13%, consumer discretionary 12.5%, and then the growth one, IT, again, consumer discretionary communication. And then the value one, healthcare, financials, and industrials. So generally, this would be kind of a better mix for me, especially when it includes financials. But many of the financials that I purchased and invested in super cheap last year are not super cheap anymore. So they actually look really good on my portfolio, but I'm not sure I would be getting into any of them at this stage of the game. The mid caps, industrials, consumer discretionary, and information technology. Heavy weighting here in information technology, but still I'm leaning towards far left IVV if I were to make a choice and invest in one of these at all. And then how about the sort of historical returns? Let's take a look at that. So you know what? It doesn't matter how you slice and dice this or which one you had invested in. In fact, I just commented to someone, I think it was Brian on our community channel. I said you could almost, you know, if you're 21 years old, you could almost buy any one of these four. Stick it in an envelope, forget about it, and open it again in 40 years' time, and you'll be shocked at the account balance that you've accumulated over time, especially because of compounding. But in addition, or you can only compound on this if you keep making small deposits on a regular basis, or otherwise if you reinvest your dividends, or preferably, especially from a young age, you do both. So if it pays you a dividend at all, you reinvest the dividend, and perhaps every time you receive a paycheck, you put a little bit more money into the investment account, and you will be astounded. It's astonishing how the balance grows when it compounds over a long period, like 20, 30, 40 years. The worst performing ETFs here, like if you look at the 10-year average return, it's still pretty good, 13.5, 12, 18. For about 100 years, the average of the Dow Jones Industrial Index, which is no longer an industrial index, but it's an index of 30 stocks, the Dow has returned approximately 6, almost 7% per year, average over 100 years or more. If you make 6 or 7% and you reinvest your Dow stock dividends, on average almost 3%, you're basically making about 10% per year. For a more mature, perhaps older investor at retirement age or whatever, that's kind of like a safe place to invest. You can call the Dow Industrial Index your shopping list if you're an older guy. But if you're a younger guy, like look at even these ETFs, I mean, they comfortably and very easily outperform the Dow. If we draw a picture and say, what do these respective funds look like over a period of time, then you can see my IVV, which is the gray line here, has kind of just been puttering along. It's not been doing anything spectacular, but you know what? 28.8% over a 1-year period. That's the graph we're looking at here. Ain't half bad. That's actually pretty good. If I had been invested in IVV last year, 2021, and I was not, I would have generated a return of 28.8% on that investment. Now, having said that, some of my investments like Occidental in 2021, Oxy generated a return for the year of about 69% almost, or it's about 60% anyway, somewhere around there. So it easily outperformed the S&P 500, but also had a few losers, right? I had stocks that pulled back like Energy Transfer, ICANN, Enterprise Partners, etc. So on average, I mean, if you can generate a return of 20, 30% per year, you are doing very, very well. And if it compounds at that kind of rate, it's off the charts. So here are the answers to the questions. Which is better, a gift of 10,000 today or a penny that doubles every day for 30 days? Well, if you take your calculator and you say 1 penny or 1 cent times 2 and you do that 30 times, the answer is 10,737,417. So what would you like, $10,000 today or a penny that doubles every day for 30 days. Take the penny that doubles. This is the most basic example of compounding. A penny that doubles every day for 30 days would be worth $10,700,000 after 30 days. How about the wild water lilies growing on the pond, doubling every day? If the surface of the water would be covered with lilies after 50 days, on which day was the pond 50% covered with lilies? Well, it would be the day before, because if it doubles every day, that means on the 49th day, it had however many lilies it had, and the very next day, it doubled again and filled the entire pond with water lilies. What's the message there? That sometimes you have to wait. Now, I'm not saying that everybody that's watching this video necessarily has 50 years to wait for that compounding investment, but there are young people watching this channel, and you might be 20 years old, and you could say, I literally have, in theory, 40 years to watch my investments compound and grow. If you can reinvest the dividend and make regular contributions into your fund, you will do fantastically well. So guys, that's sort of the wrap on this one. I don't know if you are invested in the BlackRock ETFs or State Street or Vanguard for that matter, but if you hold some of these funds, maybe you can let me know and share some thoughts with us in the comments so that we could get some discussion going. As usual, if you like my content, please subscribe because it will keep me motivated to do some more. And on that note, this is happy Sunday, what's left of it. And I hope you have a spectacular week. I'll see you guys during the week. Bye-bye.